Basically, we are going to do 3.1 again today because you already know that we are dealing with both the old and new specification at the moment. So 3.1 is about budget and actual figures to calculate and interpret the variances. We discussed that variance itself is a difference in the amount, in the figures, it could be anything. Budget is the thing or an element which we figure out by just assuming that this is a certain amount through which we will be doing the spending, expenditure, and so on. Actual figure is the allotted, the what do we call it, an original amount which need to be spent or which is spent. We will see in detail about it. All the points again are from your indicative content, each and everything. Nothing is out of the box. And details are there, and I added a real life scenario today in the class for this lecture specifically, so that it gets easier when we will be doing our task 2 or 3. Because I think it's calculation based, just a plus minus addition subtraction. The first point from your indicative content for this part was purpose and the content of the budgets. So let's start with the purpose. Budgets are the financial plans that estimate revenue, expenses, and cash flows over a specific period. Now, the specific period indicates here it could be a year, it could be 6 months, it could be a week, a day, a month, or so on, a quarterly period as well. Whereas revenue is the sales, which we do on the general basis. Expenses, the one which incurred due to any sort of, what do we call that? Maybe by paying up the rent, electricity bills, or a repairs. Cash flows includes all the inflows and outflows into the business and going out of the business. They serve as a tool for planning, coordinating activities, and controlling operation. Now, budgets, why they're important, what's the necessity behind it? Because they are used for planning for a project, for acquiring another firm or a company, and so on. The main purpose of the budget is to ensure that the organization remains on track to achieve its financial and operational goals of the organization, because we are not going to be detracting ourselves from what are the original goals and objectives of the organization. That is aims, mission statement, and the vision. Content. A typical budget includes various elements such as projected sales, production cost, operating expenses, capital expenditures, and cash flows. Now, itself, budget is an expected figure, an amount. But within it, what do we have? We have projected sales, the one which we are figuring out that in upcoming year 2025, we will be reaching this much goal. That is projections of the sales. Then production cost, the cost which is used while we are producing the goods and services, that is in the manufacturing department. Operating expenses are your working capital, the expenses which are going on the daily basis. Capital expenditures, the one which we are doing on the capitals. Capitals are your assets, maybe a machinery, maybe a building, an asset. And cash flows, again, both the inflows and outflows. It is often broken down into smaller, more specific budgets such as sales budgets, projection budgets, and cash flow budget. Again, specific streamline for these are 3. First, going ahead with the sales, then the production, whatever we are doing in the manufacturing department, and lastly, the cash flow budgets. Then we have cash flow forecast. A cash flow forecast estimates the amount of cash expected to flow in and out of the business over a particular period. Again, the time span of the period is going to be monthly, yearly, biannually, quarterly, and so on. It helps managing liquidity. Liquidities mean that the business is going to have enough cash in hand. You're not going to run out of the cash. Ensuring that the business can meet its short-term obligation, because any ambiguity or a calamity can occur, and we should have enough cash in the bank and inside the business. Importance. Cash flow forecasting is critical for identifying potential cash shortages and taking the corrective actions in advance. It also aids in planning for the investment opportunities and managing debt. So, why it's necessary to have a cash flow, a good cash flow account balance in an organization, whether it's an inflow or outflow, because the first thing is it deals with the shortage of cash. Secondly, whenever we need money or there is a problem, um, we can simply go ahead with the corrective plans, which is the backup plan. And in the end, investment opportunities, maybe you have a good deal, the broker came up with a very good plan, then we can really accrue that with the amount which we have saved already, and we're having that in the business. Managing debt, the one which we have taken from any bank or our partner too. Budgetary control process. The budgetary control process involves comparing the actual performance with the budgeted figures to identify the variances and take the corrective actions. That is the one which we have already assumed that this is going to be the perfect figure, and then we will be seeing that what we did in reality. For that, what we're going to do is the budgetary control process is the part of the budget. Steps. The first one is the preparation. Preparation about what? Develop the detailed budget for the different departments, because in the organization you're not going to inculcate the budget only for the R&D, that is the research and development department, or the manufacturing. We have other departments too. Monitoring. Track the actual performance and record the data. What is actually happening? We have already decided in the budgetary plan and the budgeted figures that we will try to achieve within this amount or within this limit. But what actually we are doing, we need to see that through the monitoring process. Comparison, compare the actual results with the budgeted figure. So what we are doing in reality, comparing it with the estimated amounts. Analysis or analysis, analyze the variances, that is the differences, understand the reasons behind them, that is why if there is a problem between the comparison, we see a huge difference of a number or any quality too, then we need to figure out in the analysis part that what is the reason, a cause behind it, what actually triggered the cause which happened this way. In the end, we have having action. Implement the corrective measures to address unfavorable variances. Unfavorable variance, that is the differences, the queries which were popping up due to some problem, due to some circumstances. We are going to see that in the part of analysis, and we will be taking the implementation plan in the action part, in the action process. Importance of budgets for the management, because the LO3 specifically is for the management accounting. That is why. Let's read it. Budgets are essential for setting the financial targets, the goals, the mission, each and everything. We need to allocate a budget for it. Allocating resources. Resources are the raw materials. It could be first hand, it could be secondary, it could be primary, secondary, and so on. And monitoring the performance. Performance of what? That what actually the workers are doing to achieve those goals and ambitions. They provide a framework for the decision making and help the managers to prioritize activities, control the cost, and improve efficiency. Now, why budget is necessary or it has a great significance in the organization? The first thing, it's set as a framework. Framework is a legal body which embodies each and everything, and everybody knows the worker, the peer groups, the senior managers, that we have to abide by it no matter what, and it helps us in the decision making, maybe in the team making or the leadership. Help the managers to prioritize activities which we're doing for the daily task, the work, each and everything. Control costs, that is, this is the, like, you can say, utmost opportunity and a responsibility at the same time. We need to control the cost expenses. Here cost means expenses. And improve efficiency, that is using less resources, reducing large quantities, gaining huge profits. This is the dream of each and every firm, whether it's a small medium enterprise or a large or even a multinational. Now we're going to talk about the types of budgeting. Till now, is everything clear to you? Zero based budgeting. This approach starts from a zero base and every expense must be justified for each new period. It helps in eliminating unnecessary costs by focusing on the current needs rather than historical figures. Zero based budgeting is all about that everything should be clear and fine. Whatever we are doing, the expenditure in a certain amount of time in a period, we need to say that everything is accordance to the expense which we have allotted, which we are assuming. With that, we need to control the unnecessary cost and unnecessary expenditures because ultimately it will increase the cost. So we will try our best when we will be using this method that everything should be perfectly going towards the goal which we have decided while doing zero-based budgeting. Incremental budgeting. This method uses the previous year's budget as a base and adjusts it for the inflation, new activities, or changes on operation. First of all, previous year budget. Whenever we are doing budgeting variances, we always compare that with the previous year because only then it is possible to see the growth, whether the business, the project, or whatever you are doing, whether it is fruitful or not, whether you grow or not. That is, if I compare 2022 with 2023, then 2023 with 2024, that is how we do the differences. And this is actually historical figure trend as well. Inflation again, the
Ma'am, my question is that is it like we have to for incremental budgeting? It's like is it a previous year budget? Like if it's like it has to be 1 year, 2 year, or just only 1 year? Suppose now we are in the 2024
it's
January,
better to
so
go for 2 years, but it is highly
hmm,
recommended when it is in
hmm,
the suggested evidence to go for only 1 year because you people are not going to make the statements. We're only going
hmm,
to write it down. So 1 year is enough.
hmm, hmm.
Because I think in the task, we're going to select an organization and then we will be doing this every process on it. Okay. It is simpler but may perpetuate in the inefficiencies from the past because obviously we do mistakes in the past, that is in the last year. Maybe this is the reason we were not able to cope up with the profit limit which we decided. So we are going to curb that in the next year. This is how things work in incremental budgeting. Then we have advantages and disadvantages of the budgets. The first advantage for the budget is provides a clear plan for the future because already we know that each and everything is pre-decided. We are having certain steps or procedures through which we are going to achieve the variances, actual figures, and the budgeted figures. Facilities coordination across departments because budget is not for one department, it is for the whole organization and it amalgamates each and every department together. So everybody is going to be doing coordination helps in identifying potential problems early. When we are doing the budgeting, we always go for the monitoring process. When we are monitoring, we actually knew that what are the problems, where the problems are lying, and how we can curb that. Encourages efficient resource allocation, that is using less resources with more efficiency in the production. These are the advantages of the budget. Disadvantages. Whereas time consumption to prepare or maintaining, that is time consuming factor. Whatever a method or tool we use in a business, it is always time consuming. Nothing you can achieve in a blink of an eye. It takes time, it takes energy. May become inflexible if not updated regularly. You need to be way too rigorous in updating each and everything, maybe monthly, not the monthly, in the businesses, specifically the large corporations and the medium enterprises, we go for the weekly rigorous update. Why? Because we need to see where we are lacking. Because at the end of the day, we cannot afford a loss can lead to short-term thinking if the managers focus only on the meeting budget targets. Short-term thinking is that is you're going to only go for those goals which are achievable in the short period of time, whether less than a year or a 6 month. But as a businessman, as an owner, as an entrepreneur, this is the utmost duty and responsibility. We should go for the larger and the long-term plans, which are more sustainable, environment friendly, less profitable too. Variance are the differences between the budgeted and the actual figures. They are used to measure the performance of different aspects of the business. I already told you that variance itself is a difference. It means differences, but differences between what? Yes. So variance in this course means that it's a difference between what? Between the budgeted figures and the actual amount. Figures, amount, calculation, all are the substitutional words for it. Now there are certain types of variances, just like we did the budget types. Favorable variance occurs when the actual revenue is higher or the actual costs are lower than the budget. That is, when we depict that the variance is going to be favorable, it is possible only when the revenue, the sales, the amount is higher than what? Than the budgeted figure. We allotted that everything should be done under 50,000 and the revenue, just because of that budget, we were able to go for, we can say, 1 lakh. So it's a plus point for a business. So it's a favorable difference for us, for a business. Whereas unfavorable variance, it occurs when the actual revenue, sales, money is lower or the actual costs are higher than the budgeted. That is, we allotted a budget to be 50,000 and we were not able to keen up with the sales. However, the amount which was actually used on the budget too exceeded. The amount was allotted 50, we spent 80,000. There is a clear difference in the amount. But the sales were not that much, they were only 40,000. So it's not a good condition for a business. We are losing it anyway. Okay. Calculating the variance, this is the formula. Actual figure minus budgeted figure. For example, if a company budgeted $100,000 for the sales but achieved $110,000, the sales variance is going to be 10,000, which is favorable. All right. Explaining the variances. In this, we have financial factors. The first one. These include price changes, cost overruns, or fluctuations in the sales volume. So the first thing is that we need to keep in mind that when we will be talking about the variance, to see our revenue and the sales, both, all right? In that, we need to see how price changes. Sometimes you are able to boost up with the prices, you curb the consumers, but sometimes it is not possible. You have to go for the sales or some lower prices. Cost overruns. Sometimes we are, or fluctuations in the sales volume. Fluctuation is the differences, the trend which fluctuate. They don't come up with the one figure, they are changing rigorously. Non-financial factors, these can involve changes in the market conditions, consumer preferences, or in operational inefficiencies. When we talk about non-financial factors, it includes, first of all, market condition. That is, whether the market is favorable, everything is going on smooth, is there any calamity going on, the political eruption is going well or not, the sales, the inflation, the employment, each and every economic indicator is going great or not. We need to say that as well because it affects the sales. Consumer preferences, what they're demanding from the producers, from the owners. We are to produce only those goods and commodities. Or operational inefficiencies. That is, we are not able to curb the expenses. They are going high and high. The daily activities, they're not good enough because the main goal is to go up with the profit maximization no matter what. Then flexing the budget. Flexing the budget involves adjusting the original budget to reflect the actual level of the activity. That is, we are going to record it. We're going to, you can say, a little bit giving a shock to it because we need to see the fluctuations in it, the changes in it. This helps in making more accurate comparisons between the budgeted and the actual performance because this is the only way that we can see the correct amount of comparison, that whether our actual or the estimated one was going great or not. For example, if the budget was prepared for 10,000 units but only 8,000 units were produced, all right? The budget was of 10,000 units, commodities, and we were able to only go for 8,000. The budget should be flexed to reflect the cost and revenues for 8,000 units. So we're going to shift the budget again. The 2,000 is going to be distributed among the, what do we call them, workers as a bonus surplus, or we can reinvest in the other project. It all depends on the entrepreneur decisions.